Hey, how's it going everyone? My name's Griffin, and in today's video, we're going to be covering a ton of information about how, as a millennial or individual from any generation really, you can start investing confidently in the stock market with as little as only $100. Over time, I've sort of taken it for granted that most people who watch my videos can follow along with what we're speaking about when talking about stock market investing. But really, it's important to revisit some of these basic concepts so that everyone is on the same playing field, and that's what today's video is all about. Now, this is going to be a very long video, so make sure that you bookmark it right now so that you can revisit this video at a later date and get back up to speed with what we've spoken about. And also make sure to smash the like button. This took me hours and hours to put together. We're going to be going through a 35 slide presentation deck that you'll be able to download. So yeah, I really hope that this video is going to get you up to speed with everything that you need to know to comfortably navigate the stock market as a beginner right now. So $100, this is a great starting point for absolutely everyone. Reason being, $100 isn't necessarily all that hard to come by, and the concepts that we're going to be learning about in today's video apply to investing $100 just as much as they apply to investing $10,000. So over time, as your portfolio value grows, all of this information is still going to be highly applicable. And $100 is also a great amount to start dipping your feet in the world of investing and start fostering more of an investor mindset where saving and investing money will be more top of mind with consistency over time. All right, so with that said, let's jump right into the slide deck. We have a lot to cover. So on the first slide here, we're seeing it's just a title slide where we're going to be learning how to invest your first $100 in the stock market for beginners. And by the way, if you want to check out more in-depth training, you can check out my website, griffinmillscourses.com. Going into the second slide now, what we're going to be learning in today's video. So we're going to do a lot of things today. What to do before you start investing, why you need to start investing today, what are stocks, quite simply, 2 different ways to build wealth in the stock market, what is market capitalization of a company. Following that, we're going to be speaking about types of stocks, categories, and sectors, because these are all very different in the world of stocks. What can you buy as a stock market investor? Because actually there are more than just stocks that you can purchase. There are different types of financial securities that we'll be speaking about. Following that, we'll be speaking about financial documents in the process of researching stocks. Financial ratios used to evaluate a stock, followed with the different types of accounts that you can open and invest in. Should you be timing the market, the time value of investing, opening up a brokerage account, and then we're going to do a full live walkthrough of buying and selling a stock using a discount brokerage, and we'll be learning about different order types and some bonuses along the way. Enjoy. Now, before moving on any further in the presentation, let's quickly speak about who I am, right? So my name is Griffin. As I said earlier, I'm 25 years old. I have an honors Bachelor of Commerce. I graduated from the University of Ottawa. I'm a serial entrepreneur. I have created multiple different businesses over the past 10 years. Some have failed, some have succeeded. And really, over the past 8 years, though, investing in the stock market has been a passion of mine. And this is, again, one of the main reasons why I decided to quit my corporate job in order to pursue teaching financial education on this YouTube channel. It's been a blast to do. Engaging with the audience is something that I absolutely love. And over this period of time, in parallel to being a stock market investor, I've also ventured on into real estate investing, where now I've accumulated over 15 doors and I'm looking to continue growing my real estate portfolio. So again, my main goal is to teach financial literacy though, and motivate others to start investing in their own financial future. Also, as mentioned at the beginning of today's video, you will be able to download this presentation for free. I'm going to leave a link down in the description. And also, while you're down in the description, you can get some free stocks and or free money for signing up for one of the brokerage accounts that we'll be speaking about in today's video. For example, Questrade, you can get $50 in free trades. Webull is also a platform where you can get some free stocks. And then Wealthsimple Trade, $25 for free when you sign up using the link down below. Finally, you can also get an exclusive discount to my full stock market investing course. There will be a unique code at the end of this presentation, so make sure to watch all the way through, and at the end, there will be a unique code for 20% off for the first 100 investors who use that code. But with all that said, let's get right into it. So it might be really exciting to want to start investing in the stock market, jumping headfirst into opening up a brokerage account and buying your first stock. But before we do that, there are a lot of steps to take into account, but they'll go pretty quick. So right here, before you start investing, the first thing is you need to eliminate crippling high interest debt as much as possible, or not even as much as possible. It needs to all be eradicated, in my opinion, before you start investing in the stock market. So I'm speaking about things such as credit cards, potentially some personal lines of credit, and pretty much any type of line of credit, including credit cards, that is going to be above 6% or more. Reason being is that in the stock market, typically speaking, over time, the stock market's going to yield annual results of around 8 to 10% on average. However, this is not going to be the case every single year. So by eliminating high interest debt though at 6% or more, you're instantly saving on a 6% return that you would be otherwise losing out on in the market. Another way of putting this is if you have a credit card balance that's 25% annual interest rate, well, you need to be able to create a 25% return in the stock market consistently in order to just beat or pay off, I should say, the interest you're paying on your credit card. So eradicating all that debt is the step number one. Once you have your debt under control, step number two will be saving up an emergency fund of 3 to 6 months. And we speak about this a lot on the channel, so I'm not going to spend much time here, but basically, in my view, having savings that are outside of the market and not impacted by market fluctuations is always the wisest thing to do when you're first starting out. So that if anything happens, your job, market downturn, whatever, you have some savings to live off of. Now, the good thing is during this process of eliminating your debt and saving up, you can learn about financial literacy as much as possible. Read books, watch YouTube videos. This YouTube video is going to be a great start. So are all the other videos on my channel, but there are multiple other fantastic videos you can find on YouTube and other resources where essentially just learning and refining your skills about financial literacy is going to be to your advantage, reinvesting back into yourself. This will pay dividends your entire life. And then finally, I would just say, have the mindset that you need to stay consistent with your investing over time. Here, we're not speaking about short-term gains in terms of day trading or anything of that nature. Make sure you're crafting a long-term investor mindset. A long-term approach to building wealth is really the way to go for more consistent returns over time. I can tell you right now that during your investment journey, there will be moments where your patience is tested, but patience and consistency in the market is key because time in the market always beats trying to time the market. All right, now from here, why exactly should you focus on trying to invest as soon as possible once you have that debt and your savings under control? And there are two primary reasons for this. The first one and most evident is because investing is going to help you build wealth over time, right? Everyone wants to make more money and build their wealth, create more income streams. So investing in the stock market is one of the easiest ways that anyone can start, as I said earlier, even with as little as $1, but in this case, let's say $100. You can start investing and building your wealth, crafting your investor mindset with very little money as opposed to other asset classes. And paper assets such as stocks and other financial securities we'll be speaking about in today's video are historically some of the best tools to build wealth over a long time frame, right? Historic averages in the stock market, at least in the American stock market, are around 7 to 10% average annual returns. And this is very good because over time, as you stay invested in the market, you'll be tapping into compound interest and other forms of exponential growth that we'll be speaking about later. Now, also right now in the 21st century, as opposed to investing at, let's say, in the 1980s or when our parents were investing, is we have lower fees than ever with some of the financial vehicles that are available to us. For example, we have access to exchange traded funds that we'll be speaking about a lot more in detail later on in the presentation, but they have very low management expense ratios. And when it comes to actually trading individual stocks, we now have discount brokerages that basically offer $0 commissions on all of these trades. So there really are no excuses to not invest in the stock market as of right now. Following on that point, there is an extremely low barrier to entry. Everyone can start investing from the comfort of their home directly on their mobile phone. And then we also have a much wider access to different investment vehicles, where in the past, individuals who are interested in investing had to be quite a bit more hands-on with their investments than what is offered right now, potentially. And then finally, investing also creates a new stream of income for yourself, and it makes your money work for you around the clock, which is ultimately the most powerful thing about investing. The second main reason why you need to start thinking about investing as of today is because investing is going to be a great hedge against inflation. Inflation is something that I'm sure everyone has heard of quite a bit in the news recently and over the course of their life. Essentially what it is every single year things become more and more expensive. That's why back in the day you could buy a brand new car for $5,000 or even less, and now a brand new car is probably going to run you at a minimum $15,000, $20,000 depending on the model. So if you just hold cash in a cash account, every single year, the buying power is being eroded away, and you can essentially buy less with that same amount of money. However, on the flip side, if you're investing and trying to create a return on that investment every year, you're able to somewhat beat inflation. That is really the goal of investing, other than building your wealth. So as mentioned earlier, on average, cash loses value every single year. It's pretty small, but up here I added a little image about the value of cash over time. It has gone down in value by almost 95%, which is staggering to think of. And with that said, in order to beat inflation, which is usually around 2 to 3% per year, your investments need to make a minimum of around 2 to 3% per year for your return on investment to essentially be flat. But investing in the stock market offers many possibilities to create a return that far exceeds that value. Now that I have you convinced about the power of investing and why you need to start investing as soon as possible, let's actually speak about what a stock even is in the first place, which might sound really simplistic, but quite a few people may still actually have a hard time grasping the concept. So quite simply, a stock is partial ownership of a publicly traded company. It's important to note here that not every company is a publicly traded company. You might go down to your local mall and see a company or a shop that is a private company. And so in that case, there is not going to be traded on a public exchange like a publicly traded company is, and outside investors cannot freely buy and sell shares of that company. But in the case of a public company, like for example, in this example, the fictitious company Griffin Public, ticker symbol GTM on the TSX, maybe one day, let's say, well, this company had 10 equal shares out in the market. Every public company has what's known as shares in circulation. So in this case, we're just going to bring it down on a much smaller scale. Let's say this company had 10 equal shares. If you were to own 2 shares of this company, you would essentially own 20% of Griffin Public. And the reason why public companies issue out stock in the first place or become public is really just to raise capital in order to fund the growth of their operations. Issuing out shares and therefore giving out equity of the company is one of the most popular ways for a company to raise more capital. An alternative is to take on more debt to fund operations, but these are the two main ways that a company can raise capital. Now, shares of a company's stock will trade on what's known as a stock exchange. In Canada, the main exchanges include the Toronto Stock Exchange, acronym TSX. We also have the NEO Exchange, the Canadian Securities Exchange, which is the CSE, and the TSXV. In America, the main exchanges are the New York Stock Exchange, the NASDAQ, the BATS, and there are quite a few more. I think there's around 13 exchanges in America. And with the concept in mind of what a stock even is, well, a public company's value is also known as its market capitalization, or for short, market cap. And a company's market value is going to be constantly changing as shares exchange hands in the open market. As traders are buying and selling shares, it is sort of like an auction house. And depending on the offer and the demand, well, a share's value will rise or decrease in value. This is why a publicly traded company's market cap can fluctuate greatly even in one single trading day. And now the market capitalization is calculated by taking the market price of one single share of the company and multiplying that by the amount of shares that are out in circulation. This is going to be different for every single public company, as every public company has a different amount of shares out in circulation. Now that we understand what stocks are at their core, let's speak about how in the world of investing, stocks are categorized as different types of stocks based on their characteristics. So of course, there are thousands of stocks available to buy in the public markets. And for this reason, stocks are categorized differently based on multiple different elements. And these are only a couple of the different types of categories of stocks. First of all, we have what's known as the growth stock. We also have dividend stocks, value stocks, and then also cyclical stocks. Again, there are more categories, but these are the four main types of stocks in the stock market. Now from here, we can also have though a mix of different types of stocks. For example, we can have dividend growth stocks or value dividend stocks. These are types of categories that can be created based on the characteristics of a given company and their stock in question. So venturing on into the first type of stock that we were speaking about, the growth stock. So right now, growth stocks are extremely popular in the current market environment. I'm speaking in 2021 right now. Growth stocks are pretty much all the rage and would have created the highest amount of returns for most investors over the past bull run, arguably in the last 10 years, but even since the bottoms of March 2020. Now, these tend to command higher valuations because typically with a growth stock, expectations for their growth is much higher. So for this reason, investors are generally willing to pay more for the company's current level of revenues and underlying net income. This is why the valuations on growth stocks are generally higher than some of the other types of stocks. Now, a growth stock is categorized by rapid expansion of operations for the underlying company. That is really why a growth stock can offer quicker capital gains than other types of stocks, because the company in question, from a fundamental standpoint, under the hood, because remember, a stock is attached to a company, it is expecting to have higher levels of growth and very rapid expansion of their operations. Now, this is also a company that generally is going to be reinvesting as much of their earnings as possible and even potentially taking on more debt to fuel this growth at a much quicker pace. These companies, for this reason, don't generally pay out dividends though, because they are using as much of their capital that they have on hand and at their disposal to just reinvest back into further levels of growth, maybe offering new product lines, developing new product lines, or entering into new markets, competing with other businesses in same geographic markets or certain industries. These are all things that a growth stock is characteristic of. Now, as a result of everything that we just spoke about regarding a growth stock though, these will generally have the higher potential for higher returns in a shorter period of time than other types of stocks, but this inherently does come generally with a higher level of risk. Always remember in the stock market that a higher level of potential growth generally is going to be attributed and also come with, I should say, a higher level of risk and volatility. So clear-cut examples of a pure growth stock right now in the market would include Shopify as well as Nvidia. Now, the second most popular type of stock available in the market that we speak about a lot on this channel is the famous dividend stock. And quite simply, pretty much any company that pays out a dividend can be considered to be a dividend stock. This is why if a company that pays out a small dividend, but it also has huge capacity for growth, can quickly become a dividend growth stock. And if that company is paying out dividends increasingly over time, this is even more beneficial for the investor. So, like I said, a dividend stock pays out distributions to their shareholders. And what distributions are basically just cash payments that a company is paying out and distributing to their shareholders simply as a reward for holding the stock. Now, since distributing dividends generally requires a good amount of net income and profits, these tend to be blue chip companies that are well established in their industries and have more consistent levels of revenue as well as net income and cash flows in order to sustain their dividend payments out to shareholders. So a dividend stock's yield though, which is something that you will hear about quite often in the world of dividend investing and even on a company's quote, the stock quote I'm speaking about, this is the yield gives investors a good idea of what a dividend's current return is in parallel to the current market price. So a dividend yields calculation, or the formula, is the dividend that a company is paying out per share in a year and dividing that by the current market price. Dividends are typically paid out on a quarterly schedule also, so every 3 months, but a company can choose to pay out their dividend at any schedule they want. It can be monthly, it can be quarterly, biannually, or even annually, but again, the most common schedule is on a quarterly basis. Now finally, a dividend stock is a good way to compound the growth of your portfolio over time, as well as creating a new source of income. So if you choose to take in the dividend payments you're receiving from your stocks and reinvesting it back into the growth of your portfolio by either buying more of that dividend stock or other stocks, this will over time have a compounding effect and will lead to exponential growth of your portfolio. Some examples of great dividend stocks include Fortis Incorporated, as well as TD Bank. And the third most common type of stock is what's known as the value stock. So a value stock, this type and category of stock was popularized by investors such as Warren Buffett, who I'm sure you're well aware of. So a value stock, though, doesn't necessarily have any clear-cut characteristics, like, for example, what a dividend stock is. If a company pays out a dividend, automatically it's a dividend stock. In the case of a value stock, it is a bit more subjective to the investor in question, because a stock that is considered to be undervalued in any respect could be considered to be a value stock. So I'm speaking about undervalued in regards to the current financials in relation to the current market price. In a higher market or an expensive market like what we're seeing right now, where the average stock is commanding a much higher price to earnings ratio than previously, value stocks can be more hard to come by and will require quite a bit more research in order to uncover a stock that is showing value relative to potentially itself in the past, as well as in relation to other peers in its industry and even the market in general. Do remember that the market price of a stock that is publicly traded is fluctuating all the time and is dictated by what investors are willing to pay for that stock at any given moment. So for this reason, a stock's current market value, when you go and search up the value of Apple's stock, this doesn't necessarily mean that it is actually fundamentally worth what people are willing to pay for it right now. So value investors try to seek out stocks that are trading for what they believe to be significantly less than what the market is currently paying for it. And you might be wondering, why would a stock be trading at an undervalued level to what it is truly worth? And there are multiple different reasons for this. It's impossible to pinpoint one given reason, but there are both qualitative and quantitative factors that come into play with how the market values a stock. By quantitative, I mean things like negative investor perception of a stock or its outlook over time, as well as short-term, maybe negative press and company earnings. Company earnings, this would be a quantitative element. So all of this is taken into account, and the market sort of dictates what they're willing to pay for the stock at the given moment. So considering what we just spoke about, there are two main wealth building elements when investing in the stock market. The first one being that dividend income. Instantly, when you hold dividend stocks, you are creating a new source of income for yourself. And then also these dividends, like I said earlier, can be reinvested for faster compounded growth like we see in this chart. The second wealth building element is capital gains. This refers to the actual appreciation of the asset's value over the course of time that you're holding the company's stock. Right, so appreciation of share value over time, and this will organically occur over an extended period of time as a company excels from a financial level. If a company over a 10-year period has 10x'd their revenues and their underlying earnings, generally speaking, the actual price of its shares will follow suit. Now, taking it one step further from the stock types that we just looked over, stocks can also be categorized into various different categories in regards to their market capitalization, so the size of the company in question. We have large cap stocks, mid cap stocks, and small cap stocks. We'll start with large cap stocks. Now, these are companies that will have a market capitalization of $10 billion or more. There are multiple different companies, and some companies are even exceeding the $1 trillion mark, which is absolutely mind-blowing. But a large cap stock is going to typically be more of an established company. So a company that's been around for a while, they have a really good customer base, and for this reason, their revenues have been at the very least steady and consistent over the past couple of years, if not growing year over year at a consistent pace. They will, however, generally provide slower and steadier returns. Now, keep in mind, none of this is concrete and set in stone. A large cap stock can show massive appreciation in a 1-year time frame, as we've seen recently with mega cap stocks in the American telecommunication and IT sectors, I should say. But as a rule of thumb, usually a larger cap company, as a result of the fact that they're already established, will not grow at the same level that potentially a mid cap or a small cap stock will. Now, also, they have a higher likelihood of paying out a dividend, reason being what we just spoke about. Because they have more consistent revenue and cash flows, they can pay out generally, or afford to pay out, a more consistent dividend. But of course, that is not set in stone. A mid-cap stock is a company that will have a market capitalization between $2 and $10 billion, and these can be sort of a happy medium between the large and the smaller cap stock, representing both growth and stability. Now, these could provide quicker returns than large cap stocks, but also these are companies that are generally going to be in the process of expansion, but aren't still a small company that's still in hyper growth phase, or a glorified startup. Now, small cap stocks, valuation between $300 million and $2 billion. These are companies that are reinvesting as much of their capital as possible into fueling growth. And for this reason, generally they will provide investors with higher levels of return in a shorter period of time, but this can also come with much more volatility and risk. Finally, a small cap stock can also potentially be more sensitive to a downturn in the economy or different ebbs and flows of the market, because generally these are companies that will have much smaller balance sheets with less cash on hand and less assets at their disposal to utilize and liquidate if ever they need to utilize higher levels of cash to sustain their operations and continue fueling their growth. And then finally, of course, stocks are shares in a company. So, of course, different companies operate in various different industries. Not every company is going to be, say, a utility company. So all of these stocks are categorized also into sectors. And for this reason, certain index funds that we'll be speaking about shortly will maybe categorize certain stocks into these different industries and create funds around different sectors. So sectors that are very common include utilities, energy, healthcare, travel, materials, industrials, consumer discretionary. These are basically consumer goods that are not essential. Then we have consumer defensive. These are essential products, toothpaste, food, all things of that nature that need to be purchased regardless of the economy. Information technology. This is everything including Apple, for example, high tech, different internet companies. All of that is grouped into information technology. Telecommunications, we have companies like Rogers, Shaw, AT&T, and so forth. And then finally, banking and finance, all the big banks, as well as insurance company and financial firms. All right, so we're moving very nicely in the presentation, and I hope that you're enjoying it and finding value. At this point, well, now we can speak about, in the current market environment and in this day and age, what are some different financial vehicles that as retail investors we have at our disposal? Because even though it's called stock market investing, there are more and different types of financial vehicles that we have access to other than just stocks. So of course we do have individual stocks, but there are many more, including mutual funds, exchange traded funds, real estate investment trusts, acronym REIT. You can also purchase bonds, real estate, precious metals, and cryptocurrencies. Real estate, precious metals, and cryptocurrencies, though, these are all assets and or commodities that are not necessarily directly traded on an exchange, such as all of the other ones, the REITs, ETFs, mutual funds, and individual stocks. Let's dig a little bit more into some of these different investment vehicles, starting with the exchange traded fund, since we already have spoken in detail about what an individual stock is. So quite simply, an exchange traded fund, acronym ETF, is a basket of stocks and or other securities that are grouped together all into one single holding that seeks to track a certain sector or facet of the market. So in this case, it's very simple, right? For example, 15 stocks that are all grouped up into one fund. fund, and then investors can purchase this fund in one single holding, and ETFs are traded and sold like a stock on a stock market exchange. Now, ETFs can be both passive as well as active. If they're on the passive side, they're typically going to track a passive index fund. For example, the S&P 500, the NASDAQ 100, or any other number of the dozens upon dozens of index funds available. If they're on the active side of things, they can be actively managed. So in this case, it means that there are actually fund managers that are hand selecting, picking and choosing the different stocks that are in the fund. For example, the ARK Innovation ETF, which has become highly popular over the last year. Now, why exactly would an investor choose to use an ETF though, and what do they have to offer? So first of all, an ETF offers instant diversification and exposure to all of the holdings within the fund. This is one of the main reasons why you would invest in an ETF in the first place. With one single holding, for example, you can have exposure to all 500 of the companies in the S&P 500, and for this reason, instant diversification without having to, by yourself, go out and pick and choose 20, 30, 40, 50 different stocks to achieve that same level of diversification. Also, the fees associated with an exchange traded fund are what's known as a management expense ratio, acronym MER. And typically, management expense ratios for ETFs will be relatively low as opposed to the MERs, or just fees associated with a mutual fund, which is very similar in nature. So a passive ETF will have very low fees, some of them being rock bottom, such as 0.03%, but this will vary depending on the fund in question. One disadvantage with the exchange traded fund though is that as the investor, you ultimately have no say as to which stocks or holdings are held within the fund in question. However, I'm a strong advocate of utilizing exchange traded funds to your advantage as a retail investor to build out a strong and solid financial foundation to your portfolio. I personally use multiple different passively managed exchange traded funds, like for example, an S&P 500 ETF as well as a NASDAQ 100 ETF. Those are two ETFs that I see being beneficial for most retail investors. In fact, moving on to the next slide, we have the passive S&P 500 ETF. I made it its own slide just because I think it is so valuable for most investors to invest in this type of fund over the long term for at least a portion of your portfolio. As stated here, it says for most retail investors, a solid base holding should be an ETF that tracks the S&P 500. This is because typically it will have very low management fees associated with the fund, and you're instantly gaining exposure to 500 of the largest companies in the United States. Now, on a historic basis, the average annual appreciation of an S&P 500 ETF is roughly 8%, and compounded over time, this is extremely powerful. US options for an S&P 500 ETF include the VOO and SPY ETFs. Those are the tickers, by the way. And great Canadian options include VFV offered by Vanguard and XUS offered by iShares. And then finally, the last financial vehicle that we'll be speaking about in this mini course is the Real Estate Investment Trust, acronym REIT. Now, a real estate investment trust is quite simply a company that owns, operates, and then finances, potentially, income-producing real estate, right? So this is a company, quite simply, that's going to hold multiple different properties, operate them, and generate income from rental income. So in REIT, this is known typically for higher levels of dividend distributions, and for this reason, a higher yield in question. This is because a real estate investment trust by law is obligated to pay out roughly 90% or more of their net income back to shareholders in the form of dividends. I'm not going to get into all of the details regarding this, but typically a real estate investment trust will have a higher than average yield. Now, REITs are a great and simple way of instantly holding and gaining exposure to real estate in your stock market portfolio without having to go out and purchase physical real estate and manage it yourself. Now, when properly managed, real estate can be a fantastic asset to hold in your portfolio, and therefore an REIT can be a very stable as well as great asset to hold in your portfolio. With that said, since they are typically made up of hard assets, real estate, well, this is going to generally have slower levels of growth over time. This is not always the case, but this is generally more indicative of a real estate investment trust. And then finally, finally, the type of property though that this trust in question will hold is going to have a direct impact on its success over time and the gains that you can expect as an investor, right? So there are different types of real estate investment trusts. For example, companies that will invest in industrial property, warehouses, logistics centers, things of that nature. Otherwise, we have apartment buildings, so residential. We also have office units or even retail malls, right? And as we just saw recently during the pandemic, real estate investment trusts that were holding primarily retail spaces saw massive sell-offs because now the whole landscape has changed in terms of the value that retail real estate ultimately has in the market. But that is the overall gist of what a real estate investment trust is. Moving on, let's now speak about brokerage accounts. Now, this might be news to you, but you actually cannot purchase and hold stocks, ETFs, or any of the other financial vehicles we spoke about previously in your typical bank account. You actually need to open up what's known as a brokerage account. And a brokerage account is what's going to allow you to hold, buy, and sell these different financial securities. Now, there are two main categories of brokerage accounts for investments. The first one being a non-registered investment account, and this will include cash investment accounts and margin accounts. The cash investment account is simply the most bare bones type of investment account that you have at your disposal. You can buy and sell all these different financial securities, and there are no tax sheltering benefits whatsoever. A margin account, which by the way, some brokerages will call their cash account automatically a margin account, is basically the exact same thing, except with the margin account, you're able to access margin, which is another word used for debt. So you're able to take out a loan, essentially. The brokerage can loan you out money to leverage up your funds in the stock market. This is not something I would recommend whatsoever for beginner real estate investors, but I thought I would still mention what it means. Now, the second type of brokerage account available, though, is what's known as the registered investment account. In the United States, for example, we have the IRA, the Roth IRA, and the 401k. Those are the main accounts. And in Canada, we have the TFSA as well as the RRSP. There's also the RESP for child education, but that's not typically something most investors will use when first starting out. So the Roth IRA and the TFSA, these are investment accounts that allow you to grow your money on a tax-free basis. Reason being, you're already paying taxes on your income in the year that you're making the investment, and then you're investing after tax dollars. The IRA and the RRSP are sort of the opposite, where in the year that you're making the investment, the contributions count as a tax deduction in the year that you made the contribution, but then later on, when you withdraw your funds, this becomes taxable income. Both are very good options, and you should be utilizing both in an efficient tax strategy for your investments. I usually tend to recommend starting with the Roth IRA and the TFSA, but ultimately that is your own decision. And once you've decided on the type of account that you want to use, say the Roth IRA in the US or the TFSA in Canada, you need to use what's known as a stock brokerage in order to start buying and selling shares in the open market. And a stock brokerage is basically a company that offers this service quite simply. And there are many different types of stock brokerages available. Most banks will have their own brokerage. For example, TD Bank, RBC, Charles Schwab, JP Morgan, all of these companies have their own investment brokerage houses, but then there are what's known now as discount stock brokerages that have become highly popular in the retail landscape. Popular Canadian discount brokerages include Wealthsimple, Questrade, as well as Interactive Brokers. By the way, later on in this video, we're going to be buying and selling stock, and this will all be in Wealthsimple Trade. Popular American discount brokerage options include Robinhood, which most are well aware of, Webull, as well as M1 Finance. By the way, there are links down in the description to some of these different discount brokerages where you can get some free money for signing up. All right, so at this point in the course, I want to walk you through buying and selling a stock on a platform. So we're going to be diving into Wealthsimple Trade and going over buying and selling a stock, as well as speaking about the stock quote, different types of orders, as well as time frames. All right, so as I mentioned earlier, we're going to be doing the demonstration of buying and selling a stock within Wealthsimple Trade. This is the platform that we're looking at right now, but keep in mind that pretty much everything we'll be looking at here is going to be applicable to any stock brokerage that you choose to go forward with. So in this case, we have the actual account value here that we can look at different growth timeframes. In this case, we have the 1 day, the 1 week, as well as all the way up to a 1 year time frame. And this is a good way of just seeing how your account has grown over time. Keep in mind, this is also a portfolio that I started very recently and that I made a full YouTube video series about, where the audience was selecting these stocks. Now, if we move down here, we have the holdings in question, and most brokerages will have holdings shown in this type of format. So if we click on one here, let's say Dollarama, by the way, each one here has their stock ticker symbol. In the world of finance, every single public company is also referred to as a ticker, just for easier referral purposes. So we'll click on Dollarama here, and just like with the entire account value, we can look at the growth over different time frames. This is quite standard regardless of the brokerage in question. And if we keep going down, you can also see your actual holding for this position. In this case, I only have 1 share for a total market value right now of $58.81. We can also see that this represents 5.8% of the portfolio and that I purchased it at an average price of $57.40. Keep in mind that the average price is also sometimes referred to as the book price of the position. We also have growth today as well as all time. So today we can see the position is down, but all time I'm actually up $2 or 2.53%, I should say. Now in the bottom section, we have the stock quote, and this is going to be found on any stock brokerage platform or stock research platform, and it gives you relative information about the stock in question. For example, here we have the last sale price, the open price, so this is the price that Dollarama opened at in today's trading period, the highest point it reached in the day, as well as the lowest point that it reached in the day. We also have some familiar things such as the market cap, the price to earnings ratio, which we'll be speaking about shortly, and then the 52-week high and 52-week low. How much did this stock go to, and how much did it drop down to in a 1 year time frame? Finally, we also have the yield, which is something we spoke about earlier regarding dividend income. Now, what about if we wanted to purchase a share of Dollarama? Well, in this case, I only have $7 available to trade in the account, so I wouldn't actually be able to buy a share because it's trading for just under $60 per share. However, we can still look at how the process would be. So you're going to, first of all, select an order type. In this case, the default is a market buy, and this is most likely going to be standard regardless of the brokerage that you use. And what a market buy is you're basically just saying, I want to buy 1 or X amount of shares of this stock, fill the order regardless of the price in question. And what this is going to do is it's going to, as quickly as possible, fill your order at whatever price someone in the market is looking to offload their shares for. Remember that the stock market is basically an auction house in terms of supply and demand. If there's more demand, stock prices go up. We can also select a limit buy, and what a limit buy is instead of just saying fill it as quickly as possible, well, you can now select the price that you want your shares to be purchased or sold at, in this case purchased. So let's say I want to buy them if it goes down to $58 per share. That is something that might happen during the day, or it might actually not materialize, and therefore my order would be nullified at the end of the day or whenever I set that order to be good for. And let's say you can also select 45 shares is how much I would want to purchase of Dollarama. That would give you an estimated cost of $2,600. The same thing is pretty much applicable to selling. Now in this case, for selling, it is in terms of how many shares you currently have. I have 1 share of Dollarama, and I can do the same thing. I can do either a market sell or a limit sell and select the price that I want to sell them at in the open market. Now, of course, depending on the stock brokerage that you choose to move forward with, there will be pros and cons to each one and different functionality available. But all of the base functionality that we just looked over in terms of the different order types, having a stock quote and stock chart will pretty much be standard across all stock brokerages. Now that we understand what a stock is, the different types of financial vehicles available, and we've even gone over buying and selling a stock within a platform, well, it's still important now at this point to learn how to actually evaluate a stock and ultimately know what you're looking at before buying. The research process of stock market investing is really important and paramount in the success of an investor over time. So when you're evaluating a stock, there are three main financial documents that are critical for the research process. We have the income statement, which is a document that's going to give you information on things such as the company's revenues, their expenses, their net income, and more. And this is going to be both on a quarterly as well as an annual basis for all of these documents, by the way. The next one is the balance sheet. This gives us information about a company's assets, their liabilities, and then also the shareholder equity. And then finally, the third main financial document is what's known as the cash flow statement. In this one, we gain insight into a company's operating cash flows, their investment cash flows, their financing cash flows, and then also their free cash flow figures, among others. Speaking about the most important elements to look for in each one of those financial documents could be a full video series in itself. And actually, I did make that video series, so I'm going to be linking it probably down below. You can check that out if you're interested. It would just be too long for today's video. However, we will be speaking about financial ratios as quick ways to assess a company's current value in the market, along with some of its financial viability. So for example, some of these include the price to earnings ratio, the PE, the PEG ratio, the price to book ratio, PB, the current ratio, and the total ratio. These are all what we're going to be speaking about right now. So the first and arguably most popular financial ratio used by stock market investors to quickly assess a stock's value in the market is what's known as the price to earnings ratio, acronym PE, as we can see here. And quite simply, the price to earnings ratio, what it does is it divides a company's market capitalization by its net profits, its net income for the year. And there are two main types of price to earnings ratio. We have the TTM-PE, which is an acronym for trailing 12 months, which takes the financial figures over the past year of the company. And we also have what's known as the forward PE. Now, the forward PE, it takes analyst estimates for and or taking into account growth projections of the company guidance on their income for the next year, and projects that out. Now, the price to earnings ratio, the forward PE, is not nearly as concrete because this actually has not been recorded by the company. So for this reason, usually the most utilized PE ratio is the TTM PE. And the PE ratio's formula basically just takes the share price of the company and divides it by the earnings per share over that past year, as I said earlier. This is used to quickly evaluate the current value of a stock, and it can be compared to its own historic price to earnings ratio, as we see up here in this chart that I included. This is the price to earnings ratio of Apple stock over time. So right now we can see that it is very high compared to almost the past decade and a half, meaning it is commanding a much higher price right now in the market relative to its underlying earnings than basically the past decade and a half. We can also compare a company's current price to earnings ratio to the average PE of the industry it operates in. In the case of Apple, it would be information technology, and also comparing it to the entire market as a whole. Now, a company can command a much higher price to earnings ratio if investors have high expectations for the company's growth in the mid to shorter term. However, you always need to ask yourself, well, am I paying too much for a company, right? A company that has a price to earnings ratio of 500 essentially means that it would take around 500 years for your investment to create enough net income to actually pay for that investment. It's not as black and white as that, but that's essentially what it means. And so the higher you're paying for a PE, the richer valuation you are attributing to that stock at any given moment. The second financial ratio we'll be speaking about that is highly popular with investors is what's known as the price to earnings to growth ratio, acronym PEG. And this is a quick way to assess a company's market value relative to its own earnings per share, which would be the PE ratio in that case if we only took those two values. But then we also use its expected growth rate over a period of time to give us the PEG ratio. So with that said, the PEG ratio is equal to the company's price to earnings ratio and dividing that by the expected growth rate. By the way, if you look at the PEG ratio of a company on Yahoo Finance, they are using the 5-year expected growth rate of the company, and they're using the trailing 12-month PE ratio. Now, when you're looking at the PEG ratio, though, it can be kind of confusing as to what you're really looking at here. So a lower price to earnings to growth ratio is usually going to be indicative of an undervalued stock given its expected growth rate. In this case, if a PEG ratio is equal to 1, it means that it is usually fairly valued. A PEG ratio that's above 1 is overvalued, and a PEG below 1 is considered to be undervalued. Now, take this with a grain of salt though, because right now in the current market environment, basically every stock you look at has a PEG ratio that severely exceeds 1, even companies that are considered to be very conservative in nature. So do take it with a grain of salt, but it's still something that you can look at in your quick assessment of a stock. So yeah, in an expensive market like right now, it can be very difficult to find stocks that have a PEG ratio of below 1. The third stock ratio we'll be speaking about here is what's known as the price to book ratio, acronym PB ratio, which you'll see in a stock's quote typically. Now, the price to book ratio gives investors a quick glance at the current share price of the company relative to the company's book value per share. So the PB ratio will compare essentially a stock's price to its current total equity, the company's total equity, that is. The price to book ratio is therefore equal to the share price of the stock at the given moment, and you're dividing that by the book value per share. You might be wondering though, what exactly is the book value? And the book value is a company's assets minus their liabilities, and then also minus the preferred share equity. Reason being is that a company can have preferred stock and common stock. We didn't really speak about that earlier, but basically common stock, or preferred stock I should say, in the case of a liquidation would be paid off first. 99% of the time though, as a stock market investor, you'll be purchasing common stock. So that is the equation for the book value. And a healthy price to book ratio will typically be anywhere from 1 to around 3. Moving on, another common ratio that investors use in order to quickly assess a stock's worthiness is what's known as the debt to equity ratio, or DE ratio for short. And this is a ratio that will also use information from the company's balance sheet, just like the price to book ratio. So the debt to equity ratio, though, it is going to be used to evaluate a company's financial leverage at any given moment, the use essentially of its debt. So how much of a company's operations are actually paid off using debt rather than their own capital and their own assets. The equation for the debt to equity ratio is the total liabilities divided by the shareholder equity of a company. And by the way, the shareholder equity you can easily find at the bottom of a company's balance sheet on a quarterly and annual basis. Now in this case though, a higher DE ratio means that the company is funding more of their operations using debt rather than their own capital and their own equity. So this inherently makes it a little bit more risky than a company that has a lower DE ratio, because a lower DE ratio means the company is using more of their own capital to fund the growth of their operations. When a company has really high levels of debt, this also means that they have a higher level of interest payments that they need to pay off, which instantly becomes a liability that is lagging on until they pay off their debt that's incurring interest payments. All right, I hope you're holding on. We're covering a lot of information, but we are getting there. The next one is going to be what's known as the current ratio. And this is something that I always look every time I am analyzing a company. So the current ratio also uses information from the balance sheet, and it gives us insight into the company's short-term capacity to maintain their debts within a 1-year time frame. So when you go and look at a company's balance sheet, you'll notice that there are different categories of assets as well as liabilities. We have short-term assets, short-term liabilities, long-term assets, long-term liabilities, and those combined will give us total assets and total liabilities. Now, in the case of current assets and current liabilities, though, these are assets and liabilities that have a 1-year time horizon ahead of them, and or that can be quickly liquidated to cash in order to use within a 1-year time frame. For example, cash can be used instantly to pay off certain liabilities, and you can can quickly sell off company stock in order to pay for liabilities, but it is much more difficult to sell off a refinement plant. That could take years to do. So that would not be considered to be a short-term asset. The equation for the current ratio is quite simply the current assets divided by the current liabilities. And short-term assets, by the way, short-term asset is the same thing as a current asset. Short-term assets are things such as cash and cash equivalents, marketable securities, as well as receivables in the year. Short-term liabilities are things such as accounts payable, taxes payable, accrued liabilities, and deferred revenues. And a healthy current ratio that I usually seek out is at a minimum 1.5. Typically, I like to see a current ratio that is above 2. An example of a company that has a fantastic current ratio is Shopify in the 17x. This means that they have 17 times the amount of short-term assets than they have short-term debts, giving them a really nice financial position. All right, so at this point in the presentation, we've spoken about different ways that you can evaluate a stock, as well as how you can buy and sell stock and different ETFs, REITs in the open market. But let's now speak a little bit more about the mindset that you need to craft as an investor and what type of strategy you're going to be utilizing. I have spoken about earlier in the video the fact that I am a strong advocate of longer term investing and investing to grow your wealth over time rather than say day trading and looking to quickly gain in value, because generally when you're doing that, you're going to be seeking out more risky investments, you're going to be more reckless with your capital as well as how you're allocating funds. So a longer term, more grounded approach is what I usually tend to recommend. Dollar cost averaging and timing the market. So dollar cost averaging is basically the idea of investing consistently into the market smaller sums of money instead of a lump sum, right? So in this example, if you were to invest a lump sum of $8,000, well, this is just an example, but what they're showing here is that if the share price remains flat at $10 per share, your return over a period of time would be 0%. Whereas if over that same 8-month period, you were dollar cost averaging, so investing chunks of $1,000 for a total amount invested of $8,000 at various different price points as the price of the stock or the ETF fluctuates, because you're getting in at various different price points, say $14 a share, $8 a share, even $7.50 a share, you're investing consistently. Well, this will give you a return of around 4%. Of course, that is just a fictitious example, but over time and historically, this has proven to be a really good way for the average investor to create higher returns in their portfolio. So regardless of if the market is up or if the market is down, just consistency in your contributions is generally going to be the best course of action. Now, this is more easily accomplished though with market funds and ETFs, broader market funds, because you're consistently investing into these larger cap stocks and larger funds that are going to expose you to the growth of the entire market. Keep in mind that if we use historic data, it has always been better to stay invested in the market for the long term instead of trying to time the market at the best moment, entering and exiting the market at times that you think are opportune. This is going to work against you, trust me, and timing the market is actually impossible. Regardless of if you're Warren Buffett, Jeff Bezos, whoever, timing the market is practically impossible, and you might be able to attempt it and succeed once or twice, but doing this consistently over time is a complete wild card. By the way, dollar cost averaging is the strategy that I use and deploy in my own portfolios, consistently investing into those broad market index funds on a monthly basis, regardless of if the market is up or if the market is down. If the market is down substantially, by the way, I will maybe allocate even more of that capital to get in on those stocks or those ETFs at a cheaper price point. But what goes hand in hand with the idea of dollar cost averaging is the time value of money and then compounding of your funds and your portfolio's value over time. So time in the market and consistent contributions are the recipe in the stock market for massive growth of wealth in the stock market, as I just said, right? Because you're going to be taking into account and utilizing the power of compound interest, which will work to your advantage over the long term and gain momentum over time. This is a clear example that I'm sure you've seen in the past, but it really showcases from a visual standpoint the power of compound interest and why investing early and as soon as possible, starting today if you haven't started, you should be investing, because compound interest over time will mean that the growth of your portfolio will exponentially grow by larger chunks each and every year. At this point, we're nearing the end of the presentation, but as I was making this slide deck and writing out the script for the video, I thought it would be really cool to include some elements that Warren Buffett can teach us and his investment style. So Warren Buffett, he has multiple investing principles, but some of his main and core investment principles include the following. So first of all, he says that a company's management is extremely important. And this makes sense because a company's management is essentially who's calling the shots on how the company is growing, how they're utilizing their capital, debt they're taking on, share issuances, and basically everything that a company is doing. So management is extremely important. If you don't have confidence in a company's management, you should be looking elsewhere for an investment. Following that, he says that you need to conduct proper research into the stock's financials and keep emotions out of investing. This is something that I have also said multiple times. Investing and emotions do not go hand in hand. If you are someone who is very emotional and you won't be able to see your portfolio value fluctuate, either you probably shouldn't be investing, but that's not the good solution. You should just invest in broad market index funds consistently and let the market work for you. Next up, he says the market can price things wrong, right? You shouldn't be panic selling just because a stock is down unless something has fundamentally changed in the company in question. The way they're operating, there's something that you don't like, then maybe you should be selling. But just price action alone is not a reason to sell. In fact, a quality stock that's going down in value, you should be seeing this as a buying opportunity. The next thing, make sure you're investing for the long term and practice patience. Patience in the market, although it's not fancy, is one of the most important elements in successful long-term investing and growing the value of your portfolio. I really hope you enjoyed this presentation, and we covered so many topics, though it was difficult to dive into depth on multiple of these topics. So I would highly encourage you, if you enjoyed it, to check out some of the other videos on my channel, such as these ones right here that cover various different things, such as stock orders, living from dividends potentially, the core ETFs that I've been speaking about, and how you can build a portfolio around core ETFs in this video, such as an easy dividend portfolio or the core ETFs. Some of the next steps that I would recommend at this point, also if you're motivated to take your financial future in your own hands and start investing, would be to download this presentation first of all, so that you can watch it again, sift through the slides, and then also bookmark this page so you can come back and watch the video once again to get familiar with the concepts. Next up, I would say open up a stock brokerage account. It is super simple, takes a couple of minutes now. We're not in 1980 anymore, and you can use a link down in the description to get some free money for yourself, and then also it will support the channel because I will get a little kickback from that. Finally, I would say fund your account and then move on to just learning more about portfolio asset allocation. We didn't really get into that all too much. So make sure to check out that video I was speaking about portfolio allocation and core ETFs. Finally, if you did make it all the way this far, I did say at the beginning of the video that I would have an exclusive code strictly for people who watched this video, where you can get 20% off my full stock market investing course, where there's 60 full video lectures, hours upon hours of content about getting you familiar with the stock market, way more in depth than what we spoke about today, and then crafting your own portfolio, building it based on your needs as an investor. I'm going to make this available to the first 100 people. So basically, I'll make this code available for 100 uses, and then after that, it'll be done, this promotion. So thanks a lot for watching and making it this far. I really hope you enjoyed the video. Make sure to give it a thumbs up if you enjoyed it. That's all I really ask in return. And let me know down in the comments, what are some things that you are doing this year in the stock market to improve your returns, or anything else for that matter. better? Let me know down in the comments. If you want to learn more about stock market investing, then subscribe to the channel, hit the bell button to be notified of new and upcoming content, and also check out all the other content that's on my channel. We've already made hundreds of videos covering stocks, ETFs, and different financial topics. I really recommend that you check that out. So with all that said, thanks for watching, and I will see you in the next one.